Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is Your Money, Your Wealth.
And welcome to another edition of Your Money, Your Wealth. Joe Anderson here. I'm a certified financial planner and president of Pure Financial Advisors. Alongside the big man, Big Al Clopine, welcome to another great show. We're heading towards the end of the year. Here's one thing that you're probably not thinking of. You're probably thinking of the holidays, Thanksgiving, but wait, here's the deal. You still have a couple of months to reduce your tax bill. If you go to your accountant, they're probably going to say, you know what? Hey, come to me in April. That is too late. 95% of the strategies that you need to do to implement to reduce your tax bill has to be done before the end of the year. That's what's on my mind today. For a lot of you, taxes are going to be an issue. If you don't know this, tax rates have gone up for the highest taxpayers. Also, when you look at capital gains tax, it went from 15% to 20%. You have the health care bill, that is another 3.8%. Now they're squeezing your deductions and exemptions, so a lot of us are going to be paying a lot more in income tax. There are things that you can do. If you take a look at the statistics, it's pretty cool, is that more people are making more money. If you look at 2008, only 25% of us got a raise. If you look at 2013, 2014, about 96% of people are getting a raise. What does that mean? That means higher income. So that's the good. The bad is you're going to pay more income tax on that income. A lot of you are getting stock options. Companies have record profits. Things are looking pretty good in the U.S. economy, so that's good news. But now, why don't you keep as much as you possibly can and not give so much unnecessarily to Uncle Sam? To help us weed through all this mess, let's bring in the big man, Big Al Clopine. So we got good news and we got bad news. Good news is that people are making a little bit more money. The bad news is guess what? They got to pay a little bit more money in income tax.
Well, that's absolutely right. And that's what's going on right now because companies are more profitable and they're starting to share some of that. Finally, they're starting to share some of that with the employees, which means we're getting raises, we're getting bonuses. In some cases, there's stock options and otherwise. And have you ever gone to your accountant when you had a good year and said, what can I do? How can I save taxes? And did your accountant say, well, don't worry about it. You made more money, just pay more in taxes. I'm telling you, that's not the right response because there's a lot that you can do. And looking at some of the things that are going on, as I mentioned, you're getting raises, there's bonuses, there's stock options. In some cases, some of you are selling stocks and property at gains, and you got these big tax liabilities. Here's what I want you to think about is between now and December 31st, you have some strategies. You've got some things that you can do to reduce your taxes, but you have to act now. And Joe, you're absolutely right when you said about 95% of the strategies have to be implemented during the tax year because there's very little you can do January 1st. You got to act right now.
How long have you been a CPA, Al?
About 30 years.
30 years. So you're pretty good at saying, you know what, hey, don't worry about it. You made a lot of tax, don't just pay it.
I hope I wasn't one of those way back when I had my practice.
So what, you were a CPA for 30 years, so you
Yes.
understand the tax code fairly well.
Yes.
And now people are actually making a little bit more money. That's a good thing.
Yes.
But let's talk about strategies on what they can do to make sure that they can mitigate the tax bite as much as they can. Because you have only a few months, a month and a couple of weeks left to make sure that you can do everything possible. And let's start out easy. You know, I think the number one thing that people should take a look at, have they maxed out their 401k plans?
Yeah, I think that's absolutely right. And when you look at what's available, your 401k plan, your 403b plan, they have the same rules. You have until December 31st to get these things maxed out. So the total that you can get into these plans would be $17,500 or $23,000 if you're 50 or older. So you want to look at where you're at. Look at your latest pay stub. See if you can get some more going into that 401k or 403b.
Yeah, for a lot of people, they're going to have to put their whole paycheck in.
Exactly.
So then if you have some cash reserves, right, take a look because you only have maybe a few more paychecks. You want to make sure that you can max those out to reduce your taxable income. And if you have other cash laying around, because here's the problem. You can't fund a 401k plan through cash. So if you look, oh, here, I still have room in my 401k of like $5,000, $10,000, $15,000 or whatever it is. I can't just cut a check and put it into the 401k plan. It has to come from your paycheck. So you want to make sure that you take a look, how much room do you have, and then maximize that as much as you can. Another thing too, if you're over 50, you have a catch-up provision, which is another $5,500. But here's the problem with most 401k plans. You have to elect to do the catch-up provision. A lot of times people don't elect. They think they're maxing the plan out, but they're not fully utilizing the pre-tax contributions.
Well, that's absolutely right. And what that means then is if you're over 50 and you want to get more into that 401k, and you should if you can, then you do have to elect a special additional election. That actually happened to me a few years ago. I got $17,500 in and it stopped. Luckily, I had plenty of time to adjust it. But here's the thing, is right now you can still affect your taxes in 2014. Come January 1st, you can't with regards to these retirement accounts. So another thing you want to think about, not all of you have 401k plans or 403b plans. So how about an IRA or a Roth IRA?
But this is the stupidest thing ever. I mean, we were talking about this on our radio show a couple of weeks ago.
Yeah.
Is that, all right, let's say that Al and I are neighbors. He works for a company that has a 401k plan. I work for a company that does not have a 401k plan, and we make the same income. Al can shelter 17, well, he's over 50, so he can put in $23,000. I can only put in $5,500.
Thanks for that, by the way.
But the makeup is helping you, man. I mean,
people thought I was a lot younger.
He's got a comb in his back pocket that was straight out of 1950. You should see the pre-workout.
You gotta love it. You gotta love it.
It's beautiful.
You gotta love it.
We got to show them.
Yeah.
But here's the deal: is that if I can only put in $5,500, even though we have the same income, just
see. I mean, don't y'all wish you had one of these?
Yeah, right.
Yeah.
Right. Oh my gosh.
I've had it for 90 years.
Yeah, I know. Oh boy. So,
all right. So I was trying to talk about IRAs.
Well, it just contributed to the IRA, but the problem is.
Yeah, you're right. If you don't have a 401k, you can't do near as much. But take a look at this. A 50-year-old can put $23,000 into their 401k. They can also put $6,500 into their IRA. Now, if they don't have a 401k, you're just stuck with the IRA. But realize this, a 33% tax bracket, you're going to save a lot of money. And 33% is kind of an average tax bracket. So you save over $7,000 per year maxing out your 401k at 50, and you save over $2,000 maxing out your 401k when your IRA in terms of taxes in the current year.
Right. Now, if you go back to that slide, Ty, if you look here, all right, so let's say Al we're both 50 years old, let's say, and he's got the 401k and I have the IRA. This is why this system is so screwed up. Al can put in $23,000, I can put in $6,500. Look at his tax savings. He saves almost $8,000 in tax. I save $2,000. If we have the same rate of return, right, he's got almost $1 million over 20 years. I have $265,000. So there's problems in government when it comes to figuring out these retirement accounts. And then now we have the MIRA, whatever that stupid plan is, where you can put $4 into it and then it will grow tax-free. Here's the deal. Depending on if you're self-employed, if you are an employee of a firm, if you have a 401k, if you don't, there's still a lot of things that you can do. You just got to think outside the box. This is what I want you to do. I want you to go to our tax planning workshop. Al and I have done this for many, many years. We have several hundred people that show up. We would love to have you. It's at the Mission Valley Sheraton. It's coming up in December. All right, so here's what you got to do to register. You can go to puretaxclass.com. I don't know if anyone can see that flyer. Or you can just call our number to register. It's free of charge. It will fill up. Al and I will spend 2 hours with you talking about all the different strategies that you need to know to make sure that you're putting money into your pocket versus Uncle Sam's. The system's not fair, but you have to understand the code for you to benefit from it. Here's the number, 888-994-6257. That's 888-994-6257. Call that number right now. Get your spot coming up December 3rd, I believe. And it's from 10 o'clock to 12 noon. It's 2 hours of great tax talk. I bet you're so excited to go. All right, we're going to take a break. We got a lot more to go. If you're thinking about some strategies, stick around. You're watching Your Money, Your Wealth.
Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors. Did you know the cost of an assisted living facility has risen to an average median rate of about $3,300 per month? That's $39,600 per year. The highest median rate is in Alaska, where it's $6,813.
Clap along if you feel like a room without a roof. Clap along if you feel like happiness is the truth. Clap along if you know what happiness is to you. Clap along if you feel like that's what you want to do. Clap along if you feel.
Hey, you know why they're so happy, Al, is that they are paying a lot less money in tax than they should
I
be
suppose.
because they
Yeah.
are tax-sensitive investors.
I like watching happy people. Makes me happy.
It does.
Makes me happy.
It really kind of annoys me.
Not me. I mean, I know that's me in a few years.
Yeah, that's
And you even a few more years after
that.
that.
Could be you next year.
I
Al.
don't think
That could-
so.
That could be you next year.
I think so.
Welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. This is Big Al Clopine. Thanks for tuning in. Talking tax planning, it's close to end of year. There's a lot of things that you should be taking a look at when it comes to your overall taxes, and that's what we're getting into today. But before we dive into more detail, let's go to the true-false question.
If I prepay my January mortgage payment in December, can I deduct the interest amount this year? And the answer is true. The answer is absolutely true. Now, here's my recommendation, is to make that payment early enough to where it gets on your Form 1098, which is sent to you by your mortgage company in late January. So pay it maybe by December 20th or so that it gets into that statement. Some of you may be thinking, well, what if I prepay 5 or 6 mortgage payments? No, you just can do one, because those other interest payments, you don't get to deduct them until that period actually occurs. So that'll be next year.
So Al, let's talk about this. Why would someone want to do that?
Well, the reason is because if they have a high income tax year this year compared to, say, next year.
So let's say I had a bonus, maybe I
Yeah.
had some restricted shares or stock options,
Yeah,
and then
yeah.
so I have a larger, or maybe I did a Roth IRA conversion or something like that, and I want to create more deductions to shelter
So-
some of that income.
Yeah, so the idea is your income is higher this year, so you want an extra mortgage payment to try to get that
Yeah,
income a
but
little bit lower.
there's other strategies that they can do too, like
sure.
maybe prepaying tax, state tax.
Yeah, that's exactly right, and that's what a lot of people do is prepay that state tax, but be careful of that one, because if you're subject to alternative minimum tax, then it's not deductible. So alternative minimum tax, we could do a whole other show on that, but that's an independent way of computing income taxes. And for those of you that have high enough income and are subject to that tax, don't prepay your state tax, don't prepay your property tax statement, because it's not going to help you. It's not going to be a deduction. But in either case, whether you're regular taxes or alternative taxes, that extra mortgage payment will help.
So if I make the extra mortgage payment, or if I prepay my state taxes, so I'm bunching that up in this year,
You're
and then next
bunching
year
it up.
I'm losing that
That's
deduction the
right.
following
And
year. So
not-
if I even
right.
have higher income the following year, then I kind of blew myself up. So you got to be careful with what kind of planning you're doing.
You do have to be careful about that. So let's talk about things that actually cause a little bit bigger deduction, and this is more of a permanent deduction. And so I want to focus on those that are self-employed or that have a business. And when you're self-employed, there's different kinds of pension plans that you can set up, and they're pretty cool. Most of them have to be set up by December 31st, so that's the key. And here you go. Solo 401k, profit sharing plan, or defined benefit plan all have to be set up by December 31st. So in that 401k, this is when you have a company, sole proprietorship, and you have no employees. If you have employees and you want to set up a regular 401k, you had to do that earlier. You had to do that by October 1st. As far as a profit sharing plan, if you have employees, that's a good way to go. Defined contribution, that's what that is. And a defined benefit plan, for those of you that make a lot of money, this might be a good plan, because you can sometimes put a couple $100,000 or more away.
Now, this is really important, because let's say if I'm self-employed, all right, so most people that Al and I see, we've been doing this for many years, have set up maybe a SEP, a self-employment pension plan, SEP, all right, and then looking at that plan, there's only so much that you can contribute to that plan. A solo 401k, you could put dollar for dollar in, so you can put in $23,000 and have a profit sharing component on top of that. We're big fans of the solo 401k if you're a sole proprietor, because you can put more money into those plans, a maximum of now, what, $51,000 that you can shelter from taxes. The problem is you have to get that plan done right now. You have to get it done before the end of the year. So look at that. If you're self-employed and you have been contributing to a SEP plan, you might want to consider a solo 401k plan and get this done right now. Now, if you do not have that set up, and then you can also set up that SEP plan all the way up until next year. So if you don't have the time to get it done, you have until next year, but we're not telling you to procrastinate, do it right now. Here's another thing that I want you to do. Al and I have been teaching a retirement tax planning course for the last several years.
Seems like 20 years.
It seems like 30 years. Every year, it's the end of year tax planning workshop. It is December 3rd. It's 10 a.m. to 12 noon. It is absolutely free of cost. What we try to do is give you last minute tax tips to save you tens, if not hundreds of thousands of dollars long term on your overall tax bill. It's entertaining, it's fun, but it's jammed full of information. So I encourage you to go to puretaxclass.com, puretaxclass.com. Absolutely do that. Register. It will fill up. We usually get anywhere from 400 to 500 people. We fill it to capacity every single year. It's a lot of fun, but even more importantly, there's so many things that you want to make sure that you do before year end. And so we do it right in December. You still have a few weeks to get all the last tax tips in for the year. So join us in December.
Yeah, absolutely. So let's get into the next tax tip. And this is one that is going to apply to you if you've sold stock or real estate at a gain. And in that particular case, you'll have to pay capital gains tax on that. And there's a special strategy that allows you to reduce your income taxes, your capital gain taxes, by looking at other positions. If you have a loss position in a stock account, you can actually sell that stock and create a loss. And this is actually so important, and a lot of people miss this. I think we're going to demonstrate that, Joe. I think you're going to be on the board.
Well, I mean, the concept is called tax loss harvesting, and there's so much confusion when it comes to this. Let me just draw this out real quick, because here's what the market does, right? It goes up and it goes like that. It goes up, it goes down, but it trends up. So what we look at is that in areas where the market is down, okay, so here's an opportunity. Now, these assets have to be outside of your retirement account. It has to be a capital asset. So any asset, mutual fund, stock, bond, anything that is held outside of your retirement account that is subject to a capital gains tax. We want you to sell the position when the market is down, but we don't want you to sell and go into cash. We want you to sell and buy something similar. You're selling mutual fund A, you're buying mutual fund B. For instance, let's say I had $200,000 in my portfolio and it dropped to $150,000 just for S&Gs, right? Now I'm down 50 grand. What I can do here is I can sell that mutual fund, okay, and buy something very similar. I don't want to sell and go into cash because it will take me forever to recoup. I still want to be in the market. So I sell mutual fund A, buy mutual fund B. What happens there is that I have a $50,000 now capital loss that sits on my Schedule D. That loss will offset any gain dollar for dollar. I'm not telling you to buy really bad investments, but if I go back in time to 2011 was a very volatile year. But the S&P, if you go back, it was dead flat. So if you fell asleep, right, you didn't lose any money, but a lot of people lost a lot of money because of the volatility. So here's what happened. Let's say that I had $100,000 invested, right, Jan 1 of 2011. Well, in the beginning of the year, the market was up about 6%. But if you remember, we had the debt ceiling. The S&P downgraded the Treasury. We had a tsunami that blew up Japan. And what happened was the market free-felled, right? But then it rebounded and it ended up dead flat. So if you look at dividends, you were actually up 2%. So at the end of the year, you still had 100 grand. But here's what we would take a look at. In this area here, okay, the S&P dropped 20%. So your $100,000 is now worth $80,000. Okay, so you're down $20,000. We would say sell mutual fund A, buy mutual fund B. Still be in the market, right? We still want you to be in the market. Now, by doing that, I just created a $20,000 capital loss that sits on my tax return. But I'm still in the market, remember, and the market recovered, and at the end of the year, I still have the $100,000. But what I did is I harvest this loss when the market goes volatile. Okay, so now this $20,000 is available for me to offset any gains, any future gain that I have in a stock, bond, mutual fund that is outside of retirement. Now I can create tax-free income with this. It's so powerful. Join us at our tax planning course. We're going to talk a lot more about these strategies. It's coming up December 3rd, 10 a.m., 12 noon at the Mission Valley Sheraton. 888-994-6257, that is the number. Or you can call 855-99-TAXES. That's a little snazzier number, 855-99-TAXES. We're going to take a break. Don't go anywhere. Show's called Your Money, Your Wealth.
This week's question is, what are the tax implications of annuities? Annuities have become more commonplace in recent years. However, many people purchasing annuities are not aware of the tax implications of this type of investment. Today, we're going to take a look at how annuities are taxed in comparison to other types of investments. First, let's take a look at the two primary ways investment gains on non-retirement investments can be taxed. The first is ordinary income tax. This is the highest of all tax rates and can be as high as 39.6%. The second is capital gains tax. This rate is 15% for most people. However, those in lower tax brackets will pay 0%, while those in higher tax brackets will pay 20%. Capital gains tax applies to gains on certain types of investments that are held for at least 1 year. Next, let's take a look at the rules for annuity withdrawals. If I invest $100,000 in an annuity and it's now worth $150,000, I'm not able to withdraw my initial $100,000 investment until I withdraw and pay taxes on the $50,000 gain. This fact in itself will give you a lot less control over your tax liability and your cash flow. Compounding this problem is that all of the gains on the annuity will come out taxed as ordinary income, again, the highest of tax rates. Often, if you had had the same or similar investments held outside of the annuity, say in a regular brokerage account, for example, you would have paid the lower long-term capital gains tax rate, which is typically 10 to 15% lower than the ordinary income tax rate. Annuities also have considerable tax disadvantages for your beneficiaries. Many investments will receive a full step-up in basis upon your death. What this means, for example, is that if you purchase a stock or a mutual fund for $100,000, and when your beneficiaries inherit the investment, it's worth $150,000, they would pay no tax at all on that $50,000 gain. However, if this same investment were an annuity, they would not only owe taxes on the $50,000 gain, but it would be taxed at their ordinary income tax rate, which again is the highest of all tax rates.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out with you today, talking taxes. Hopefully you're enjoying the program. Got a few minutes left. Wrapping things up today. First and foremost, we have our annual end-of-year tax planning workshop coming up in the next few weeks. It is in December 3rd to be exact, at the Mission Valley Sheraton. If you would like to learn more about how to mitigate your taxes before year end, I would encourage you to go to puretaxclass.com. You can go to puretaxclass.com. You could call 888-994-6257. There's multiple ways to register for the course. It will fill up. We will have a few hundred people there, and it's a lot of fun each and every year. So if you want to learn ways to mitigate your taxes before it's too late, 95% of the strategies you have to do before year end. That's why we do it right now in the next couple of weeks, December 3rd at the Mission Valley Sheraton. Love to see you there. Let's go to the true-false question.
If I have a loss from my rental properties, can I always deduct that loss against my other income? And the answer to that is false. You cannot always do it. In fact, your income has to be below $100,000 to deduct up to $25,000. Once it gets over $150,000, you can't deduct those losses unless you're a real estate professional, which is a whole nother matter. Now, we got just a couple more minutes, but I want to tell you guys about a strategy that is very popular and not too many people know about it. And that's when you're thinking about your charity. When you're thinking about your charity, there's a way to give future year contributions and deduct them this year. Let me explain. The way that you do that is you set up a special kind of an account. It's called a donor advised fund. All you do is simply take some of your dollars and put them inside this fund, and it can stay in that fund for as long as you want it to. And the year that you put it in the fund is the year that you get a tax deduction. So that's the key here.
So if you look at it like this right now, so let's say if I make a $5,000 contribution, right, each year, I could bunch that up and say, well, maybe I put $20,000 into the fund this year, get the $20,000 tax deduction, then I dole it out as I choose to in the several years to come.
That's exactly right. And the reason you would do that is if you're in a higher bracket this year than you're going to be in future years. You get that tax deduction right now, and later on in later years is when you give that money to charity at your discretion. There's no minimum or maximums. You can let it grow for 20 years if you want to, or you can start pulling it out right away and have it go to charity. Better yet is how about giving away appreciated stock, because whatever it's worth is your tax deduction, and you don't have to pay the tax on the gain. It's just a really good way to create some tax deductions when you have a high income year.
Yeah, it's a great strategy. It's called a donor advised fund. So again, if you're looking at ways to reduce your taxes this year, if you're already giving a charity, check it out, the donor advised fund, where you can get a lot more deduction, a lot more bang for your buck, if you will, if you have a higher tax year, or you can combine different strategies. We talk all about this at our tax planning workshop, end of year tax planning. It's a big deal. It can save you a buck. It can save you hundreds of thousands, really depend on your specific situation. You just have to show up. We are at the Mission Valley Sheraton December 3rd, 10 a.m. to 12 noon. Love to see you there. The number's right there on your screen. Call that number to register. We will see you in December, but then again, we'll see you again next week. For Big Al Clopine, I'm Joe Anderson. The show's called Your Money, Your Wealth. We'll see you next week.